This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 8th. Some highlights from today's show. A dead cat bounce is now in play. Let's go through some tariff trade scenarios, and I've got some great chart porn. Good day traders, and welcome to another daily market rundown. It's relatively calm over the last couple of hours in the European session. We of course have had two very big comments, retaliatory comments, first from the US, of course yesterday from Trump telling him, look, I'm going to put another 50% on you if you retaliate, with China then coming out today and basically saying, look, if that's the way you're going to play, we'll fight to the very end. So we've had a lot of negative, almost as bad as it could get in terms of rhetoric, and yet the markets are staging a nice little grind higher. So what that does suggest is the market is now full to the downside. We'll get into that in a moment. So let's start off with our first topic of today, and let's talk a little bit about some of the overnight sort of commentary. So what's happened, of course, we all know what's going on with the tariff situation. We effectively have Trump now telling China, well, look, we're going to put 100% tariffs on you. Now, again, the way the market's looking at this is it's kind of looking and saying, no, you're not. Okay, we cannot have a situation where the two biggest economies in the world are hitting each other with 100% tariffs. There just simply won't be any trade. And that's where the market's looking at it. It's looking at it as there's too much bluffing going on. Yeah, mine is bigger than yours kind of rhetoric. And in reality, what's going to happen is there will be some degree of negotiation, and the agreed tariffs will be nowhere near 100%. Okay, that's the way the market's looking at this now, and that's also the way the market's trading. Okay, if you look in terms of the last two negative comments, in terms of retaliatory comments we've had, in both instances, the vol actually went down. In both instances, the degree of the drop not only was quite limited, but it also reversed relatively quickly. Okay, now what this means is the market is full to the downside. What that means is anyone who wanted to sell, anyone who's forced to sell has already sold, and ultimately the market is quite full on the downside. Now when the market's full on the downside, what you typically need is a bit of time, or you need fresh news that ultimately takes markets lower. Okay, so right now it's unlikely we're going to get any fresh news in the near term, and more importantly, it's not like that anyone is ultimately going to start getting very aggressively short after the aggressive move we had to the downside. Okay, does that mean this is the end of the bear market move? No, perhaps not. Okay, there could well be quite a bit more downside, and we'll discuss ultimately what will determine if there is more downside coming over the next couple of days and weeks. Now, I think in terms of timelines, what's important to understand is we've effectively got just under 24 hours before the higher end tariffs are imposed across the globe on the likes of particularly China and Europe. Those are the two big trading partners for the US. So it's very much a countdown now. In the next 24 hours is going to be a lot of back and forward, and of course a lot of potential opportunity scope for traders. So let's go through those trade scenarios, because this is ultimately what us as day traders do. Okay, we look at the situation, we understand the market's positioning, the sentiment of the market, the volatility in the market, where the hedging is, and then what we do is just build out some scenarios, and if those scenarios eventually, if they actually happen ultimately, we can then take advantage of them. So what are some of the things that you need to understand? This is crucial. First and foremost, the markets really desperately want to know now if this is temporary or permanent. Okay, and alongside that, what is that effective tariff rate? Now, what does this mean? Currently, Goldman Sachs is talking around a 22.5% tariff rate. Okay, so this is basically the average tariff rate when you include all countries, based off of that chart, that fancy little chart that Donald Trump showed everyone. Okay, so this is the effective rate that the US is charging. Now, coming into this year, it was around 2.5%, and so we can see there's been a significant jump up in the effective tariff rate being charged by the US. Now, ultimately, the market's trying to price this. It's trying to understand, well, look, if the effective rate is 22.5, what happens to GDP? What happens to earnings? What should the price of the S&P be? Forward pricing, blah, 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 blah. Okay, and the market's trying to price this event. Now, the first leg of this has been priced, which is the market has liquidated, fear has ensued, and we've had that very aggressive sell-off where the market's just said, get out, so we can now start to build some calculations and actually figure out what the heck the ultimate path is going to be if we do actually get 22.5% tariffs. Okay. Now, the important thing is, like I said, the first thing the market wants to understand is, one, are these going to be permanent? Okay, are we actually going to have higher tariffs as a permanent feature for the next 4 years of Trump's presidency or not? Now, obviously, there is this sort of room for negotiations. There's this talk that countries will negotiate, and perhaps all of this is just the White House trying to force everyone to remove their tariffs. And ultimately, at some point, we move our way back to that 2.5%. Okay, now this is how it works. If you think of it on a scale of 22.5 down to 2.5, right now the market's probably trading somewhere around, I would say, this 15%. Okay, so 15% ultimately is this number where there's an expectation that a large degree of countries will negotiate. Trump will remove some tariffs on some people, but ultimately we'll still have higher tariffs, but not as high as the 22.5. Okay, and this is how you have to think of it. Think of it as a gauge. If no one negotiates, if everyone retaliates like Europe, like China, we're going to go more in that direction. However, if EU negotiates, if China negotiates, we're going to move more in that direction. Okay, and if the negotiations go really, really well, maybe we move in that direction. And that's how the S&P, that's how risk is going to trade. Risk is going to trade. We sold off. We're now pricing roughly somewhere around 15% marginal tax rate from tariffs. So if all of a sudden negotiations start to go well, S&P will rally. If things start to go really bad and Europe retaliates, we're going to go even lower. That's how this is going to play out, and that's why it's important you understand the scale. What is that effective tax rate, and ultimately are these permanent or temporary? Now, Wall Street still thinks there is some degree of negotiation, well, not some degree, there's a lot of negotiation going to go on. The base case is very much that there'll be a lot of negotiation and that these tariffs will prove to be mostly temporary. There'll be some degree of tariffs. It will be higher than 2.5, but it's not going to be anywhere near 22.5. Okay, that's the way the market's currently pricing. Now, in terms of today, what can we listen out for? Well, there's a few things. One, is there a country extension? This is a high probability play today. I wouldn't be shocked if today you hear of Indonesia gets an extension or Thailand gets an extension. So what the White House could do to save a little bit of face, obviously we did have some rumors out yesterday of an extension of 90 days, which were very quickly squashed. What we could have today is one of those country-specific extensions, okay, where the US says, look, Indonesia's done a fantastic job. Look how much they're giving up. Look how they understand what we're trying to achieve here. We're going to give them 45 days extension so we can really sit down with their leaders and discuss exactly what a trade deal will look like. And anyone else who wants to sign up, look, the tariffs are still going into play, but we're here to listen to you. That's the kind of news flow I expect we're going to get today, which is we are willing to give extensions, but only if you show us the money. Show us that you're serious. Show us that you are actually going to sit down and make some concessions, and we will then give you that extension so that we can talk. Okay, this is a high probability play today, and I wouldn't be surprised if you get something like that early on in the US session. Okay. Of course, there's the ongoing battle between Trump and President Xi. They are sort of playing this tit-for-tat, mine's bigger than yours type game. The reality is this will go down to negotiation. Okay, the market is seeing this absolutely as this will have to go to negotiation because you can't put 100% tariffs on each other unless you want to pretty much blow up trade with each other. Okay, so right now, yes, the rhetoric is very negative, but I expect this only gets better. I think this is as bad as it can get, and I do expect a phone call is the kind of thing you're going to listen out for today. Okay, Trump to schedule a phone call with what's his name, or Besant, or anyone in Navarro, any one of the key sort of US figures to hold a phone call with one of the China delegation figures, and I suspect the market will just assume that that's very good news, and we'll finally now start to get China and the US talking. Okay, that's all the market wants to know. They just want to know they're talking. Why? Because then we move a little bit away from this 22.5 back down towards that 15. Okay, that is the key right now, is how much on either side of that 15 are we? Okay, in terms of then targeted tariffs, I think this is something that perhaps not today, but definitely we can see Europe playing this game. Europe is talking about, look, if you hit us with tariffs, we are going to counter you with tariffs, but we're going to do it industry specific. Okay, now the reason they're doing it industry specific is because then it's more targeted, but it also leaves room for negotiation. Okay, so don't be surprised at some point if we do also see the US saying, look, we're willing to consider on some of the countries like EU and China more targeted type tariffs where we hit only certain industries rather than a blanket tariff. Okay, again, what does that mean? Well, if I go back to my scale between 22.5 and 2.5, it means if it's targeted versus an average across the board, it means the marginal tax rate moves back down towards that 2.5. Okay, so again, we'll be taken quite positive. And then again, an unlikely one, but we are in an unlikely presidency. But don't be surprised if the calculations get adjusted. Okay, so again, this would not be a good high probability play, simply because it would make the POTUS look a little bit embarrassing. But ultimately, there's some form of an adjustment on the calculations where they say, look, we're willing to relax some sort of non-tariff barriers in the calculations, and they kind of just create a word jumble of random rubbish. But it ultimately means the calculations come down. Again, in terms of the scale, we start to move back down towards that 15 and perhaps even lower. Markets will take it as a positive. Okay, so keep in mind, this is the key lesson today. 22.5 to 2.5. Think of this in terms of a scale. Goldman Sachs is thinking that by the end of the year we'll be at 15%. JP Morgan is talking about if we hold this 22.5, the S&P 500 will trade back down to 4,000, which is roughly another 20% from. Now, contextually, coming into the session, VIX is still very elevated. Does this mean we can't rally? No, of course not. We can rally very much with an elevated VIX. We could very much see that VIX trade back down towards that 40 level today. I suspect that's probably what we're going to get. Just a bit more compression in the VIX, but a 40 level in the VIX means we are very much not out of the woods. It just means the market will be a little bit more relieved today, and we should hold on to an early bid. But again, I think the key takeaway today is watch how we trade up in and around yesterday's highs. Okay, I think we're going to have a real battle up in and around those yesterday's highs in both NASDAQ, S&P 500, Dow, and of course, the Russell. So pay very close attention to yesterday's highs. I think they are going to prove to be a very big barrier. Now, in terms of junk bonds, they are responding. Credit spreads are moving finally. However, let's just put a little bit of perspective in place. In terms of the sell-off of Q22, okay, keep in mind 22 was the last bear market correction we had. You can see we staged a rally, made a higher bottom, and then rallied from that point. We're not even at those levels yet. Now, yes, the S&P 500 is not even close to that 22 bottom either. That comes in around, if I'm not mistaken, 4,500. So we are a long way off those levels. Credit spreads are widening, but they're not exactly sort of alarm bells ringing. Okay, but definitely one you want to watch out for, because sometimes the junk bonds typically lead the equities. In other words, junk bonds today are opening up around those 92s. Should we take out that low and make another lower low, with the equities perhaps making a higher high or an equivalent high? Okay, the junk bonds are going to be signaling a recession a lot quicker than the equities. Okay, so keep an eye on those junk bonds. If we do get back down to those Q4 23 levels, that was of course when the S&P staged that significant rally in late 2023. If we do get back below that and the equities haven't yet extended those recent lows, don't be surprised to see more downside in the equity. So keep an eye on junk bonds. Okay, and then what is a dead cat bounce? Important to discuss this. What does it look like? What does the shape of it look like? Because it's important to understand contextually how this plays out. Okay, and I'm going to use COVID as a very good example because it's a fantastic chart to lean on. COVID, a lot of uncertainty. No one knows what to do. Just get the hell out. Okay, that is what COVID was. We had 14% down day in 14% down move in 6 days. Okay, very, very similar to what we've had now. Of course, this was a little bit quicker, but ultimately, this is what it looks like. We have a very aggressive sell-off, and then we get this sort of day of relief where the market is a little bit full to the downside. Everyone that wants to sell has sold. We then get the big green day. Okay, a really, really big green day, but ultimately it cannot get below that plunge day. Sorry, it cannot get above that plunge day. Okay, you can see the very next day comes in, still cannot close above that plunge day. The following day, still cannot close above that high of that plunge day. Very next day, still cannot get above it, and then the market rolls over. Okay, and this is how a dead cat bounce works. It feels, for all intents and purposes, quite strong in terms of price action. It doesn't feel like you're getting rewarded initially for being short, but ultimately the market just cannot get sort of hold any kind of a strong bid. Okay, that is the key takeaway from a dead cat bounce. It feels aggressive. It feels like, wow, where's all this coming from? But in reality, when we put it into perspective in terms of the depth of the bounce, it just really isn't that strong. Okay, and once that offer comes back in, all right, no one really wants to be long the market. Sentiment is still very weak, and we then roll over. Now I'm going to fast forward because you can have a look. Similar kind of setup. We're down 16% in 3 sessions, a lot quicker, warranted. Like I said, I think that 5,300 is going to be crucial. I think yesterday's highs are going to prove to be perhaps the high of the dead cat bounce. Don't be surprised to see today come up here, test that high. Tomorrow, test that 5,300. The next day, perhaps test it again, and then eventually later on in the week, perhaps next week, roll back down and test that 48.50. Okay. Yesterday's bottom, I suspect at some point will trade again. so long as, and this is the key, so long as, I'm going to keep drawing that scale for the next couple of sessions, 22.5 to 2.5, so long as we stay above that 15 level, okay, ultimately that bottom is going to be tested. Okay, that's how you have to start to think about this. What shifts all this? Okay, if all of a sudden we start getting below that 15, VIX gets back below that 30, okay, don't be surprised to see this market stage a deeper bounce. Okay, does that mean the bear market correction is over? Perhaps not, but of course this is a fluid situation and we'll take this one day at a time. And then finally a little bit of chart porn, because I just like a little bit of chart porn. You've been hearing a lot about this, how Trump is very victorious, very, very proud of himself for ultimately getting yields lower. Well, has he got yields lower? I think the way you have to look at this and understand this is that the White House's objective here is ultimately to get those yields lower so that they can actually finance their debt in the latter half of this year. They've got a significant amount of issuance coming up in the next 3-4 months. And ultimately, they do want those yields to be a lot lower. Otherwise, the interest component of their debt is going to be substantially higher. Okay. Now, what have those yields done over the course of this 20% correction in the S&P? Well, we can see ultimately that when that correction started in mid-Feb, we were trading around 460 in 10-year. We're, as of today, trading around 416. Okay, that is hardly a move you would want to see. 45 basis points is not going to cut it in terms of what the White House wants. They want to see that substantially lower. Now, of course, Jerome Powell came out and he told us, hey guys, we ain't doing anything anytime soon. But ultimately, the verdict from particularly the long end of the bond market is that interest rate cuts are not going to solve this problem. Okay, what the bond market is telling us is that this is a stagflationary type slowdown where we're going to have slower growth and sticky or above target inflation. Okay, it's very much what the bonds are showing us. In a typical traditional recessionary type moves, you would not be seeing yields still at 416. Okay, the reality is that the markets right now are sending a very different signal to what the White House wants, and ultimately, at some point, should these yields start to move higher without the equities bouncing back up, okay, don't be surprised to see yields start to act as a very, very significant pain for the equity markets. Okay, not there yet. I think there's a lot that needs to happen before that actually becomes a correlation we'll watch. I suspect somewhere around that 435, we get above there, or even around there, that 440 level. At that point, fine. You are going to start to see how high yields will cause a significant problem for those equity prices. Okay, that is then a wrap for today's session. There's a lot going on. You need to be nimble in these markets. You know, you want to be a buyer and a seller. You want to trade the opportunity flow. There's a lot going on in the next 24 hours. It's not a time to be a euro. Now is the time to dust off that dead cat bounce playbook. It is very much in play today. Call it turnaround Tuesday, call it whatever you want, but very much a more constructive day to be both a buyer and a seller. Things do seem to have calmed down a little bit. All right, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Manage that risk. Go make some money.